Welcome to UBP's 2020 Outlook podcast with Peter Kinsella, UBP's Global Head of Forex Strategy. Today, Peter will be giving us some insights about the US dollar and what's to be expected for the year to come. Peter, it looks like US growth momentum has eased. Do you think this trend is likely to improve meaningfully in 2020?
Hello. I don't think it will. It seems as though we've entered a period of slightly slower growth in the States. That's a reflection of the trade war, which we've seen, the lagged effect of the sanctions or tariff implementation, and it's also a return to rather slower trend growth in the States. So we're not really expecting any improvement in US growth. We think it will moderately decelerate in 2020, probably to levels of around 1.9% year on year in the US. So the overall sort of growth trend in the United States certainly looks as though it's going to decelerate coming into 2020.
And how do you think traditional safe haven currencies such as the Japanese yen and the Swiss franc are going to perform?
This will really be a reflection of global growth dynamics. And what we tend to find is that when you see an environment where the US Federal Reserve is cutting interest rates, when they do that in an environment of low global growth or slowing global growth, what we find is that those traditional safe haven currencies like the Japanese yen and indeed like the Swiss franc, they tend to outperform. So certainly in the early part of 2020, when we have a combination of slowing growth globally and of course then falling inflation, you'll find that these safe haven currencies should do quite well. Eventually we may well see a modest pickup in growth, probably from the second half of the year onwards, and that's just as the lagged effect of interest rate cuts throughout the world sort of start to take effect. But certainly in the first half of the year, the likes of dollar yen can get to levels of around 100, and dollar Swiss can easily fall to levels of around 0.95. So risks are on the downside for both dollar Swiss and indeed for dollar yen.
And how do you think the dollar's weakness could manifest itself?
Again, this will depend on one, how and when the Fed cuts rates, and two, what's happening in global growth outcomes. The first regards the dollar. The Fed have signaled that they want to remain on hold or put a pause in their rate cutting cycle. So we don't anticipate any rate cuts pretty much until the end of the first quarter. So you're kind of looking at February or March. And of course that will be data dependent. What we see is that growth in the States is slowing and global growth is slowing as well. And this is largely priced in. What isn't so clear is the overall inflation outlook. The forward-looking indicators that we look at, the likes of Chinese producer prices, etc., they tend to be a very good leading indicator for Eurozone inflation and, of course, for US inflation. And the Chinese PPI is trending lower at an increasingly alarming rate. This suggests that we could see a decline in core CPI and core inflation prints in the United States, and that will be a worry for the Fed. So consequently, we think that the risk is that the Fed may well have to cut interest rates, in the early part of next year, and this as yet isn't priced in. If the Fed are cutting rates in an environment of slowing growth and indeed of slowing inflation, as we said a moment ago, the safe haven type of currencies will tend to do quite well. If the Fed is cutting rates in the context of global growth picking up, then we're likely to see the likes of currencies with a traditionally higher beta to US growth or global growth doing quite well. And that would be the likes of the Australian dollar, the Canadian dollar to a lesser extent, and then some of the more solid names in emerging markets, such as the Russian ruble and the Mexican peso. They would tend to outperform in that environment. So really, it's really will all depend on what's happening outside of the States in terms of global growth dynamics rather than inside.
And what's your opinion on the trade war and the impact it might have on the US dollar?
What we've seen so far is that the trade war has seen the implementation of a number of tariffs, certainly on Chinese goods and vice versa. And we've seen that the global manufacturing sector has fallen into a significant contraction. So if you look at manufacturing PMIs around the world, they're showing you a very, very significant contraction. In the early part of the year, that led to the underperformance of pro-growth or cyclical currencies, such as the Swedish krona, Norwegian krona, the Australian dollar, New Zealand dollar, etc. So the effect isn't seen so much in the dollar itself, but it's seen in those currencies which tend to have very open economies. And again, Singapore, of course, and Korea, Taiwan, these are all very heavily export led economies, and they've taken quite a lot of pain in the last year. That's really so the main effect that we see. It's not so much on the dollar per se, but rather on those currencies which tend to have a higher beta to global growth.
And do you think the euro or the dollar will appreciate over the course of 2020?
Our basic view is that we think euro-dollar will appreciate to levels of around 118 by the end of the year. That's a reflection both of the fact that we think the European Central Bank has simply run out of policy options to weaken the currency. We think they've done as much as they can do regarding the deposit rate cuts, which are now at minus 0.5%. I think there's quite a high bar for increasing quantitative easing quantities coming into 2020. The ECB is probably unlikely to do anything for the next 6 months, certainly as the new president ECB, Ms. Christine Lagarde, gets involved and certainly starts her tenure there. So really that says to us that European rates are not going to do a lot. On the contrary, if we look at it in the States, we think the risk is that the Fed may have to cut rates next year. That isn't priced in at all, and consequently the euro-dollar up move will really be a reflection of dollar weakness rather than aggressive euro appreciation.
And what about emerging market currencies against the dollar? What do you anticipate?
What we've seen this year is that emerging market currencies in general didn't do a lot. And that's quite interesting because normally we find that emerging market currencies tend to be heavily or highly correlated with US 10-year yield developments, which is to say that when we see lower US 10-year yields, emerging market currencies tend to outperform. And that wasn't the case at all this year. We saw US 10-year yields fall as low as 1.5%, but EM currencies didn't do very much. Instead, what we saw was that emerging market currencies displayed a much higher correlation to Chinese renminbi exchange rate moves. And that makes sense in the context of global trade war because many of the regional players in Asia, such as Korea, Taiwan, Singapore, they both import into China and they also are competing against China for exports into the United States. So what that really says is that when the Chinese renminbi weakened by 2 or 3% following all of the tariff implementations, you saw that the likes of Korean won, Taiwan dollar, Singapore dollar, they all weakened more or less in tandem with that. So the broad outlook for emerging markets is that in the absence of much higher domestic and or external growth, the EM currencies are not going to do an awful lot. There will be some EM currencies which will do okay. We think those emerging market currencies with very high real interest rates and decent current account situations, they will do well. So in that context, the likes of the Russian ruble, very, very solid fundamentals, very high interest rates, high real interest rates adjusted for inflation, and of course a very solid current account surplus of around 7% of GDP. So the ruble will do just fine in that situation. Likewise, the Mexican peso will do okay. Again, it has a combination of very high real interest rates, high nominal interest rates, falling inflation, and a current account, very, very small current account deficit, which contracted a little bit in 2019. So these two currencies can do perfectly fine. Those other emerging market currencies, the likes of Turkish lira and Brazilian real, they will fall into a camp where they've got quite thin or rather small real interest rates. And if we see any deterioration in sentiment towards emerging markets, those two currencies will underperform, we think, in a pretty bad way. So overall, we think it's a mixed bag for EM. In general, not going to do an awful lot. One or two currencies, as we said, the ruble, the Mexican peso, they'll do perfectly okay in the coming year.
And about the competitive dollar for Jobs and Prosperity Act, can you give us some explanations, tell us what it is about and what its impact could be?
Basically, the idea here is that the US authorities are concerned about the strength of the dollar. And they think that the dollar is way too strong. And according to most of our valuation metrics, the dollar is indeed quite strong. If we look at it in trade-weighted terms, in real effective exchange rate terms, the dollar trades at multi-year highs. So the US authorities are definitely right to be concerned about dollar strength. And what they're doing is that they're trying to bring in this new act, which will effectively put a tax on capital imports towards the United States. So if you imagine an investor buys a US 10-year bond, or he buys US equities, or perhaps even some FDI going towards the States, they're looking to put a kind of a tax on this with the idea of discouraging investment towards the United States. The mechanics of this, however, are rather more nuanced, because if you put a tax on a capital import, implicitly what that means is that your capital account will decline in your balance of payments, which can only be offset by a contraction in your current account deficit. And what we know from history is that whenever we see an aggressive contraction in the US current account deficit, it actually leads to a recession in the United States. So the risk in this situation would be that we see an aggressive contraction in the current account deficit that is offset then by Federal Reserve rate cuts, which of course will weaken the dollar, because hedging costs for the dollar will decline quite quickly. So the idea, of course, is to weaken the dollar, but the mechanics of it could actually involve a rather sort of nasty shock to US growth dynamics. We'll have to see how it turns out over the year. At present, this is still sort of an ongoing discussion in the States. It doesn't look as though it's going to be enacted or implemented, in the short term, but it's certainly something to keep an eye on. And indeed, that's what we'll do in 2020.
So, Peter, in your view, what's the key takeaway for FX investors in 2020?
I think the key takeaway would be to position for some modest dollar weakness in 2020, certainly in the early half of the year. And indeed then as the data develops, as we see the type of situation we have in the world, whether we see a pickup in global growth, if we do, then certainly buying higher beta currencies against the dollar. That would be, of course, the likes of Australian dollar, Kiwi dollar, and Swedish krona, etc. If we see an environment of the dollar weakness, but with slowing global growth and slowing global inflation dynamics, then certainly selling the dollar and buying the likes of the Japanese yen and the Swiss franc. They're the key takeaways in 2020.
Thank you, Peter. So more podcasts on UBP's 2020 outlook will follow in the coming days.